Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, and see what people are sharing. You want to follow me at Finance Grow Finance. If you want to join our community, finding-value.com. I dive deeper into all these topics, looking for potential investment opportunities. I do a lot of macro-looking stuff too. I like to do some trainings before some of these question and answer sessions every once in a while. And I try to answer your guys' questions with my experiences. Mayday coupon code is still active if you're interested. Eric Nettles, so net length as of Tuesday cutoff, approaching levels that historically have marked a bottom in oil. We are likely even lower than reported given price action Wednesday and onward. While markets have loosened, I still believe the market is too bearish and misinterpreting certain signs. That very well could be the case. Or maybe the market has it completely locked down. Either way, we are at a very low level in terms of, I should say, oil is very cheap in relationship to gold. I think it's something on the lines of 1 ounce of gold is equal to 36 barrels of oil, which is incredibly cheap for oil historically. It doesn't mean it can't get cheaper. We can see that net oil length is at probably all-time lows almost, or very low given history. We could be at a bottom. We might not be. And that's the difficult part because this negative sentiment could have some validity to it with the yield curve un-inverting and all of those things. And sometimes we've seen some pretty big pullbacks in oil with a slowdown in the market or recession with the market. So we have seen pretty large pullbacks in oil, and maybe we still have downside left. We have to wait and see that the market comes in here, buyers, and puts a floor underneath it. I don't think we've seen it yet. We could be close, but again, we have to wait and see. I don't determine the market, and just because you have some of these, net oil length and some of these other things that we look at doesn't guarantee that we have bottomed. It just gives us some information where it's evidence of where we're at in the cycle, perhaps. And now we have to look to see if we actually get the bottom. Here's Tavi. He says, the 2 versus the 10-year yield spread turning positive this week is likely one of the most critical macro events we are experiencing. And I'm sure all you guys have noticed all the selling pressure in the market, and it's been across all of the sectors. It's because of this, the 2 and 10-year yield and the spread turning positive. So historically, these un-inversions tend to happen abruptly, and the current situation has been no different. These types of macro setups occur only occasionally, and I believe the steepening of the U.S. yield curve still has a long way to unfold. So we still have potentially some time, some more selling pressure in the market as this unfolds, and as the yield curve un-inverts, we've got more rate cuts ahead of us. So it might take some time for this to work its way through the system. So be patient. Sean Gorlam says, I've had 72 cars. The worst I've ever had are Land Rovers. The second worst have been Subarus. Currently having bad luck on a 2015 Subaru. Terrible cars. Just a quick thing. I know this is a financial channel, but it is value. The worst cars that my parents and myself have owned has been Toyotas. They've been the worst. That one ZZ engine is crap, and it drinks fuel. My parents owned it, and after they owned that, they said they'd never own another Toyota again. That's been our worst car. It was in a Toyota Matrix that they owned. All of the other cars, Hondas, I think, are the best that I've owned. Every Honda has been amazing to me. We've had 4 Hondas in the family, 4. And they've all run over 200,000 miles or greater if we wanted to keep them. I have a Chevy Aveo that continues to run. Absolutely amazing car. I love it. And some reviews say it's bad, but I've had great luck with it. And Toyota's been our worst. Aren't you glad you listened to serial pumpers like at Uranium Insider and Monology and on uranium stocks? Guys, I just want to say this. It's not cool to say crap like this. Um, Justin's a good guy. There's nothing wrong. The fundamentals of the sector look absolutely awesome. And he goes online and shares all of that information for everyone to hear. He goes to all of these different YouTube channels and shares all of the information that he finds and researches quite openly. And just because he is bullish on uranium, and rightfully so, the fundamentals of the uranium sector look absolutely fantastic. I just see this as very, it's very shallow and disingenuous. Like, you're not genuine here saying stuff like this. So I don't like seeing stuff where they're putting other people down, and he's done nothing but come out and be an awesome person for sharing all of that information. He's never said no to me coming on my YouTube channel. He goes to all these YouTube channels. I think he's an absolute, excellent individual. So I don't like seeing this crap, guys. I don't. They used COVID as the excuse to inject 20 trillion in fiscal stimmies 5 years ago. What will be the excuse this time? And this is where I want everyone to pay attention. When we get the yield curve to uninvert like we've seen, given history, this is where they do a false flag event. 9/11 occurred when the yield curve was dropping a little bit further than where we are at today. We also had COVID that occurred when this was coming back down. They could create an excuse, just like they did all those other times. So if I am right, and I don't know, we don't know, but this is when it occurs. This is the high likelihood time, the high percentage time that something goes down. It's when their buddies all get positioned in bonds, and then something comes. I don't know what it is. I can't tell you what it is until after it occurs. All I can tell you is something could occur, and if it were to occur, it would occur probably pretty soon. And this is the time frame it occurs on a lot of the times. So if something does occur, we know that it was most likely an event that they knew was coming, because all their buddies, hey, go, Bezos and Gates, Zuckerberg, hey, sell some shares, get out of the market here. And then all of a sudden, they're going to push this to extreme lows so their buddies can buy other assets at extremely low prices. They have to push the market up and down through the yield curve, through yields. The yield curve is what inverts and whatnot. And then when it uninverts and they do that, they like to do some sort of event to really drive it to the downside. This is official and definitive U.S. city rankings. Tier 1 cities, New York, Los Angeles. Tier 2, San Francisco, Miami, Chicago, D.C., and Tier 3 cities. I would only live in Tier 3 cities. I don't like any of these Tier 1 or Tier 2 cities. I just saw that. I'm like, there's no way. I lived in L.A. for a very short period of time. I didn't think it was that bad, but I'm not going back there. No way. There's this positive. They have a lot of car parts that you can get for really good prices. That is a huge positive to me. But everything else, outside of the weather, everything else is pretty bad. Fed's Waller, if future data shows significant deterioration in labor market, Fed can act quickly and forcefully. Yeah, they could. If we get significant deterioration in the labor market, which we probably are. And that's probably why they're signaling this. It's like, hey, if we really get deterioration, which probably is coming, that's why they're saying it, the Fed can act quickly and forcefully. Peter says, the past few weeks, we've been told oil is down because of an imminent ceasefire, which didn't happen. The Libya restart didn't happen. Inventory builds didn't happen. The Saudi Arabia policy change didn't happen. A hard landing didn't happen. Meanwhile, positioning is worse than 2008. Do you get it yet? They very well could be trying to push this lower too, for the presidential election, if you know what I mean. Here's Dibinology. He says job security is a myth. Your job can fire you at any time for any reason. You need something paying you regardless if you are working or not. This is why I buy dividend stocks. Dividend stocks gives you another stream of income. And that's one of the reasons why I have it as well. And I'm trying to grow my dividend payments as big as I possibly can to put more resiliency in my life. Another thing that's really cool about dividend stocks that maybe a lot of people don't realize. If you acquire a bunch of dividends paying stocks, let's say you've got 20 or 30 dividend paying stocks that are paying on average over 10%. And you've got an amassed a good portfolio around a lot of these dividend paying stocks. They are also subjected to commodity price fluctuations. So their dividends go up and down based off commodities, which is good if you're in a commodity bull market. Maybe not here in the short term, but in the longer term, it will be. What's cool is they don't all pay you the same time. Some of the stocks I'm in pay me on a monthly basis in the middle of the month, like the 15th, like Canadian oil companies or something. And then I think Canadian REITs also do something similar to that. Then you have other payments like tankers and dry bulk shipping and all these other ones that pay out quarterly. And then they don't pay out at the same time too. So I get all these dividends all over the place. They just keep coming into the account, and I'm just like, this is so awesome. And as you put more money into it, obviously you get more in dividend payouts. And yes, if it's in a taxable account, you have to pay taxes on it. But if you don't have income, depending on what your income is, if you're married, I think the first $95,000 of dividend income is tax-free. Tax-free. So there are things that you can do to set up your life where you could really benefit if you've got no income, if it's all coming from dividends where you can get really big tax discounts is what I'll call it. Brandon Balo says, it took a while, but crude oil finally got back down to $68 a barrel. Now I'm getting interested in getting long. We'll see if it can hold here. And again, I think this is one to watch here. Oil's incredibly cheap against gold. I think it's something around 1 ounce of gold to 36 barrels of oil. And with the price where it's at, very interesting here. I'm watching it like a hawk. And there could be things that I'm start to fire off on if we get positive developments. And just an FYI, if you're part of the website, I do have some purchase history that I updated for everyone. Just an FYI. Dividend Hero, he says, the best part about the stock market tanking is that none of us have to worry about unrealized gains. I thought that was funny, but partially true. If the stock market's tanking, no one's going to be worrying about unrealized gains. Fed's Waller, he says, I do not believe the economy is in a recession or necessarily headed for one soon. All I'm going to say is this to everyone. They cannot tell you that the economy is heading for recession. They would create fear and panic. So every time these guys come out, no matter what, they're going to have to say something on the lines of this. Even if a recession's coming, they're going to say, I do not believe the economy is in a recession or necessarily headed for one. They're going to tell you that every time. So you don't know by using this verbiage if a recession or not a recession is coming. You have to look at the yield curve. And if the yield curve's un-inverting, which we're getting, it's probably a good shot that it's in the cards. Flash Bond Trader says, surely we must be at the bottom now. I never thought we would reach these insanely low levels with such strong fundamentals for uranium. This is painful. And all I'm going to say is the markets do what the markets are going to do. And there was the possibility of a slowdown coming, which we could see with the yield curve. We could see it with the unemployment rate. So when you combine those two things, the macro picture starts to overwhelm the fundamentals of the sector. So I think a lot of people could use this as a learning lesson is the macro trumps the sectors, the fundamentals of the sector under certain conditions. And it will only last for a period of time. No one knows how long it will last. We don't know how deep the correction could be. And it could be very painful. But you just have to know that something like that is a possibility. I didn't know that when I was a new investor. Now you should know that the macro picture can trump the sector fundamentals. Here's Travis. He says, my brain just can't process how someone as dumb as Kamala Harris becomes vice president and now the presidential candidate. How many idiots do we have in America? And I couldn't stop laughing, guys. I couldn't stop laughing after I read this because I had very similar thoughts. I'm like, how can we have this person who talks in circles and doesn't say anything about policies or how to correct anything? I just don't understand. I don't get it. And I try not to make this a political channel at all, which I don't. But I just read this and it hit something. I just started laughing. It's like, oh my God. U.S. natural gas rigs, they fall 1 to 94. A news cycle low, down 22% year to date. So nat gas, we were all the way up at 160 rigs, 2023. This is going to be a real interesting mix here because we have a whole bunch of LNG capacity coming on for the United States and up in Canada. So this could turn around pretty quickly. Early stages, early 2025, maybe middle of 2025, we're going to have to increase production at some point here. And I'm sure rig count will go up when that occurs. But right now, it is a cycle low, and I would be looking. That's what I would be doing. Investment wisdom, there's a 100% correlation between what happens to a company and what happens to the stock. The trick is it doesn't happen over a week or even 6 to 9 months. That's terrific. Sometimes fundamentals get better and the stock goes down. That's what you're looking for. That's what you are looking for. The fundamentals get better and the stock goes down still. That's our opportunity. And I hope people understand that. That is the entire purpose of trying to invest in these markets. We are trying to find that disconnect between price and value. And I think we are in a similar situation to that right now with oil. Oil, natural gas, and some of these other ones, some of the energy service companies, we've got the fundamentals that are looking better and better year after year, quarter after quarter, and the stock price is going down right in front of our face. It's happening right now. Now, does that mean that it can't get cheaper? It could. It very well could. But I think we've got another quote coming here later with Howard Marks that I want to read to you too. A4 Alpha says, TMF, fear and reality are off markedly in the energy markets. Global recession fear has sentiment low, which causes computers to position the same. Not much can be done but buy and wait. Companies are buying back shares and issuing dividends, which indicates health. Only time remains. I would agree with him. 100% I would agree with him. Now, that doesn't mean we can't go lower in the short term because of the macro global recession fear is still out there. Kobayashi letter says, you can't make this up. The June and July jobs report were just revised lower by an additional 86,000 jobs. This is the second time that the June jobs report was revised lower. Six out of the last 7 jobs reports have now been revised lower per zero hedge. In fact, 11 out of the last 15 jobs reports have been now revised lower. We are talking about millions in job revisions over the last 2 years, and these are the revisions here in the red of how it's been revised. So, you know what they're probably doing? This is my guess, guys. This is my guess. I think that they are purposefully getting the unemployment to go up because that is what's good for inflation. The more people who are out of work or don't have work, they want to impact the inflation and try to hold it down. And they have to do that by keeping the unemployment rate high. So they're playing with the numbers so they can do this longer for long. So they're doing it higher for longer, and he can hold that up there, but he has to fudge the unemployment rate numbers, is my guess. So Powell, the way that you bring inflation down, and one of the tricks that I think he's doing is he's like, well, we're just going to have to get people unemployed to bring the inflation rate down, but they're continuing to, in the background, do fiscal spending. The government is. So I think it's just games. They're playing games. Oil stock bag holders go, so what is the bottom? 60, 50, 40? The oil market is an absolute free fall, and no amount of bullish news seems to stem that plunge. To the analyst and wannabe hedge funders who have been calling for much higher oil prices for years now, please delete your accounts, is what he says. This is generally the stuff that comes out when negative sentiment hits. So more people become negative sentiment when the price moves down. They don't become negative when the price moves up and the price is moving up. They become negative at the bottom of the market. So I bet you we're probably closer to a bottom than maybe what we think. Maybe a short-term bottom. I don't know if we ultimately bottom in the 60s or whatever, but maybe we do hit the 50s. Who knows? We'll see. But this is generally what you start to see. Eric Nettle says, view from the trenches, buy orders taking 5 seconds to get filled. Every broker report is now negative, spewing the exact same thing. Weak China, U.S. recession, Saudi losing control. And watching months of effort vanish in days. We're firmly stuck in a negative feedback loop. Read the exact same thing 10 times and feel incrementally worse each time. What's the catalyst for a turn? Not sure at this point. I'll be closely watching net length update this afternoon and updated Kepler data early next week. 1 week old inventory data to me is not a lagging indicator. Sentiment today is the worst in a few years. Veterans, greater than 2 years, and the energy investors have been here before. We'll be here again. This too shall pass, and buying businesses with very strong balance sheets, long-dated inventory, and the ability to generate competitive shareholder returns, even at current pricing, will, in my opinion, be rewarded in time. I would agree with that. And as we fall, I'm a big bull on oil. I love oil. There's a ton of value in the sector, is what I'll say. And I just look at it like, God, I want to get a piece of this, because these companies can make so much money when this market turns back around. So I get very bullish I get bullish when I need to be bullish, put it that way. This is over $250 million in share cancellations for Canadian Natural Resources. So a lot of these companies are doing share buybacks. They're canceling shares out up in Canada. Huge opportunities in a lot of these areas. Here's Peter Lynch. So Peter Lynch on the temporary disconnect between fundamentals and share prices. He says, often there's no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. In the long term, there is 100% correlation between the success of the company and the success of the stock. This disparity is the key to making money. It pays to be patient and to own successful companies, says Peter Lynch. We should all take this to heart, and we need to deploy that when there's fear in the market. Be greedy when others are fearful. Be fearful when others are greedy. So I'm not saying it's happening right this second. What I'm saying is we need to start to adopt that mindset, because soon we can get these opportunities. Baron of Ivy, he says, interesting. HFI Research throwing in the towel on RIG. They were buyers at 670 on the 3rd of April when they published RIG buy data or buy idea. That's 37% lower, though the TBF is probably annoying for them to publish on the day of the local peak. But I don't really understand how they can say the macro part of the thesis is playing out as expected, but Transocean's financial performance has failed to meet our expectations. Though I can't read whole updates as paying. RIG's reported financial performance is a heavily lagging indicator. I do get worried about the future, but minus 37% is a lot of compensation, and with exception of perhaps reactivations, the macro thesis is ahead of my expectations from spring at least. Industry consolidation, DR contract term progression, initial proof of value of HE monopoly. I actually think that this sector, the offshore drilling, looks really good to me. I think it's all intact. But yes, short term, since we're going through a slowdown in the macro, supersedes the sector fundamentals. That is your opportunity. The macro is impacting the sector fundamentals. The macro supersedes the sector fundamentals. And that's your opportunity. I'm trying to tie this in with opportunities here. It doesn't mean that we've bottomed, but we need to be looking for a bottom. We can't get bearish when prices are low. That's when you got to get bullish. Christine Guerrero says, Spears and Associates outlook for U.S. rigs and frac jobs indicates flat to down production for 24 and 25. Efficiency gains are in the rear view, wells getting gassier and higher WOR. So this is the average active rig count's been falling, and then frac jobs have also been falling. And they say that they could potentially still be low in 2025. The macro is driving this, not sector fundamentals necessarily. Demand destruction versus supply. If you're early on in your career and they give you a choice between a great mentor or higher pay, take the mentor every time. It's not even close, says Stanley Druckenmiller. Canadian Natural Resources limited buybacks in August, a whole bunch of shares. We also have Cenovus Energy Insider buying shares. What I'm seeing is I'm seeing a lot of insiders in oil buying shares across the board. A lot of buys. And I'm not talking just one or two. I'm talking like every company has a whole bunch of CEOs loading up on shares in oil. What's going on here? What's going on? Is the market wrong, or are the insiders of the oil companies wrong? I don't know. Time will tell. Warren Pies says August payrolls, residential construction payrolls tick up to a new cycle high of 951,000. July revised down slightly 3,000 jobs. There's a lot of nuance under the surface, but for now, this data is in line with the soft landing thesis. What is the soft landing thesis? The housing market. Remember, I talked about the housing market yesterday. I talked about the home builders and their stocks going up. Residential construction payrolls tick up to a new cycle high of 951,000. Soft landing. That's where I think we could be. And that's where I think the oil guys are getting it right. Because they're loading up on oil. When the interest rates fall, we could see construction go up. We could see new home builds, housing starts go up. That's going to be a big move to the upside for commodities, in my opinion. That's the exact same situation that we went through in 2001 to 2002 to 2003. Now, this doesn't mean it's going to be immediate. It could take time. It could take 6, 7, 8 months for rates to come down, for the housing starts to go back up. Like, it doesn't mean it occurs immediately. It might take some time. So, like, be patient here, guys. Patience gets paid. Home builders are still strong, and that's where I put up there. Leonard Corp just continuing to move on up at almost all-time highs. We've got Toll Brothers that are almost at all-time highs. And then we've got Meritage Homes Corporation at almost all-time highs. And they have bullish-looking charts. That goes along with the new cycle high of 951,000 for residential construction payroll. It's all interconnected here, guys. The slowdown's coming from the tech side. We're in a tech and S&P 500 bubble. The valuations there are over, they're way up there. They raised rates. We got a slowdown in inflation. They slowed it down. That's going to kill some jobs in that sector over there. But this is going up. This is what's going to hit next. It's just like 2002. 2001, 2002, as we go through. 2001 is the slowdown. And then we go and we bottom in 2002. And then that's where the dollar drops and all that other stuff. And commodities rip. Warren Buffett sold 18.7 million more shares of Bank of America stock over the past 3 days for $760 million. He's now sold more Bank of America stock on 6 trading days in a row. Berkshire Hathaway's stake in Bank of America drops to 11.1%. Here's more about the commodity markets, because this is all interconnected, guys. It's all interconnected. The first thing that occurs is you get interest rates to go up. The second thing that occurs is you get a slowdown in the market. The slowdown in the market is going to precede a lowering of interest rates. The lowering of interest rates is going to drive the dollar down, the United States dollar. So I'm going to read this. The Australian dollar has just had its first candle above a significant resistance level, likely signaling the start of a new uptrend. To be clear, this isn't the kind of movement you typically see in a deflationary environment. He is correct. Soft landing would have the Australian dollar ripping to the upside. We have a weaker dollar because of the lowering of the interest rates. We've got the home builders making new all-time highs. We've got construction cycle high of 951,000. We've got insiders buying the crap out of oil. Put it all together. Put it all together. What is that telling us? We've got the Australian dollar breaking its downtrend. We've got the Canadian dollar breaking its down. Well, it's about to break something, I think, soon. It's still underneath its trend line. We've got the Brazilian real ready to break to the upside. The currencies are telling us what is coming, and the setup is very similar to 2002. Go back and look at 2002. Do the analysis. It's all very similar. And that I did last time. So we're going to end it there, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. This is all. I go over information like this showing my data on the charts in TradingView and stuff like that. So if you guys like these types of connecting data together, that's kind of what I do at a lot of the question and answer sessions. I connect data. I connect charts together. I show everybody the big picture. It's important to understand the big picture. Why? Because that's what gives you the investor confidence, the confidence that something is coming, and it gets you the vision, the strategy. Like this is our strategy, this is the vision, this is what is coming ahead of us. This is why I think it's coming ahead of us. And then I show you a bunch of charts which include currencies, ratios, all these different things, the dollar, yields, yield curve, the real estate market, how that all works, and then over, I'd say, a good 6-month period of time, you start to learn a lot of different things and how to view the markets. It gives you a viewpoint of the markets, is what I'll say. So it's very valuable, in my opinion, to gain that viewpoint. But that's where I'm going to leave it, guys. So we'll catch you next time. This is Finding Value.